Welcome back to the Generational Investors Podcast, where we explore the timeless principles of building lasting wealth. I'm your host, John Woodard III, and we're here back this week with President and Founder of Woodard Company, my father, John Woodard. And this week we're going to be getting into the quarterly recap of the second quarter of this year, 2026. A lot's happened then, and there's just a lot of things to go talk about, and also just things looking ahead. We thank you for joining us.
Yeah, and we're a little bit into the third quarter now already. So
we're almost a month in the third quarter here. So a lot's happened since then.
Yes.
But yeah, we kind of get into that. So just getting things started here. We'll just kind of go through first the economics of things, earnings and everything. The S&P ended the first quarter down 4.9%, and then it turned things around. Earnings growth has been resilient. It ended up being 28.6%
earnings growth. The earnings growth, not the S&P.
Not the S&P.
The S&P was up over 14% second quarter.
Second quarter. So anyways, if you want to get into a little bit about earnings and
a lot of the volatility we're seeing is a lot of it's the Iran war, the price of oil especially, and the uncertainty there. And so, oil surges up to, $100 a barrel. The markets react negatively. Lots going on. You got a new Fed chairman as well, and a lot of the governors aren't really on board with what he's wanting to do. So you've got a lot of uncertainty coming into the third quarter, and the S&P, say in the second quarter did better than 14%. A lot of it was driven by the techs. But it's by these semiconductors in particular, like Micron and SanDisk.
Micron and SanDisk, yes, especially. And I think they accounted for, the information technology sector accounted for about 32% of the gain. They were up 32%, and then so that really helped weigh in on things. Them and also industrials and energy, those have been the three top performing sectors.
And this is against the backdrop of other positive economic factors like deregulation, lower corporate tax rates. There's headwinds. We saw the headwinds, like I said, in the second quarter. We're seeing headwinds again now because we're in the third quarter. Some of these stocks were up, 500%. Like SanDisk, what was it up? It was
it was up at one point, I think, like 600 or 700%.
Yeah, 600 or 700%. And so you would expect them to take a little breather here, and they are taking a breather, pretty serious.
We've been seeing it across the whole sector for this month, especially.
Yeah, from the high, SanDisk hit like 2,600, and now it's at like 1,300. I mean, it's retraced about 50% of the.
Today it's actually like 1097 or something like that.
Is it really?
Okay. It's down like 15 or so % today, but that's it's a weird thing that things have been kind of shifting in the markets, and this is a little bit more in the third quarter now, but the Kospi, the South Korean index, about 50% of the index is composed of SK Hynix and Samsung, and they're both also memory plays, but if they go down in a day, the rest of the American markets are kind of going down in a day. But that's another thing that kind of happened throughout second quarter was just an influx of money with the SpaceX IPO coming in, as well as that was the largest IPO ever, and then also SK Hynix was listed on American the NASDAQ, and so that was the largest foreign ADR put on.
And you're also seeing, and once again in the background, you're seeing with the tariffs, you're seeing onshoring of manufacturing. It takes time to do it, but it's started. The capital has started flowing in to break ground to build these. I think we saw what was it, Toyota that's going to make it was Tacoma trucks in Texas instead of Mexico because of the tariff situation, and so it's bringing jobs in the manufacturing. I think the Rust Belt may once again become what they call, what kind of belt were they back 50 years ago? Anyway, the manufacturing is returning to the country. Unfortunately, for a lot of the Rust Belt, though, Ohio is an exception. They're doing pretty well, but because of the labor unions in the Northeast and Upper Midwest, a lot of these manufacturers want to go to Tennessee. They want to go to South Carolina. They want to go to Texas.
Different laws and regulations, and less taxes.
And the labor unions aren't the the demand there. So Southerners will work and not necessarily organize, and so you've got a lot of factors going on there, but it is onshoring and manufacturing's coming back.
That is, and that kind of drives into just the employment numbers and everything too. That's been a good driver.
Yeah.
Overall, unemployment rate stayed at about 4.2%. The jolts, the job openings and laborers turnovers, 7.6 million, the highest in 2 years, and that just means that turnover. There's about 7.6 million jobs just coming around, being available, and there's 1.3 job openings for every unemployed.
1.4.
1.4.
And there's one of those numbers, and it was the best number since 1969.
It was initial jobless claims.
Initial jobless claims since 1969.
And that's when they had about half the workforce we have now.
Yeah, it's incredible.
So
there's going to be demand for workers, and we saw for many years we've seen people. The unemployment numbers 2010, 12, 14, 15, unemployment kept dropping down, but it wasn't because of the new jobs were being created, but it was because people were dropping out of the workforce. And I think we had like 8 million people who could have worked, who choose not to, and get on welfare and other things. So that trend is, I think too, with perhaps the illegal immigration circumstance being contained somewhat, wages were depressed because of the folks willing to work for less coming in, and that's not the case now. And you look at almost all the hiring. In fact, all the hiring is from U.S. Citizens, and so it's changing. I think the dynamic there is if you pay people a little more, they'll work, and so I think that's what. Yeah, who knew? So that's what we're starting to see some of these dynamics.
That's good.
But the incredible thing was, the correlation. Earnings is the biggest correlation to market performance. It's like a 94% correlation. And over the we saw the year it started out. They said we're going to have 13% earnings growth. We talked about this a minute ago, but just to put this for the S&P 500 companies. Then I think somewhere in March they changed it to 19% the earnings growth, and then during the second quarter they changed it to 28.6% earnings growth for the S&P.
Unreal.
It really is.
And these numbers are typically only seen if we're coming out of a recession where just everything's sunk in, and so you have essentially no earnings, and so you'll see numbers like this coming out of that. But just we haven't been in a recession, we haven't had any issues like that. It's phenomenal. I mean, it just shows the power that we are in as we consider the fourth industrial revolution. Yeah. Just AI is propelling.
And so our concerns for the quarter is, third quarter typically is a soft quarter. Mm-hmm. A lot of people are unaware the year end for mutual funds is October 30th. And so you've got all these funds. It used to be a little more powerful than it is right now because so many people have gone to ETFs, but they're harvesting their capital gains, or they're making their portfolio change, or they're selling stocks. And they tend to they're going to sell their losers and this type of thing. So that's one of the factors. There's numerous other factors, but this year we also have a midterm election, and typically you'll see a bottoming somewhere in September, October, in that time frame. We've gone to equal weight and we have
overweight stocks
recently, and we've raised some cash. We harvested some losses in a few positions in the stock portfolio, and we plan to plug them in. But if you're doing this for your own account, you may want to think about it. Usually by about mid-October, it's over. The washout is over. The sellout, and I realize the elections are not till November 2nd, but usually the washout is over about mid-October, and then you want to see. And if you think back in history too, like 1929, October. 1987, Black Monday, October. 2008, October.
When did Lehman Brothers go out?
Yeah, Lehman Brothers went out the 23rd of September.
Okay.
And so, and of course the elections, McCain, Obama elections were going to be, month away. In October, it just sailed off the cliff. So October, I remember my first couple years in the business, 1978, 79, 80. And I was talking to an older gentleman who I had partnered with, and And I said, does it go down every October, in September, October? And he started laughing. He said, it seems like it. And this guy had been in the business since 1929, which is quite a while.
That's unreal.
Yeah, he was in his 80s. So anyway, we think we might see some consolidation in the third quarter. We're seeing it. We're actually seeing it right now in
We are.
in the semiconductors.
And it's mainly just tech too. I mean, if you look at it, like the RSP, the equal weight S&P index, that, and also just value and somewhat small caps as well. Yeah. They've been performing decently well.
Yeah.
But if you look at it like on a given day, typically if semiconductors or tech's down and most everything else is up. So I mean that's kind of the broadening out trade that a lot of people talk about.
And just a brief comment on gold, because there's so many people interested. We saw gold hit 5,500. Now it's at about 4,000 an ounce, and everybody's talking about it for a while, but we're down about 6% year to date, I think, something like that for gold. If you look. And we did when we did the podcast on gold, we talked about this and said, it used to be inflation, not anymore. Look at 2022, didn't happen. Used to be world events. Look at the Iran war. Market didn't care about that. And we said in the podcast, it's the dollar. If you look at the dollar, and sure enough, the dollar is strong this year.
It's been strengthening ever since about March or so. Yeah.
And what has gold done? It's gone down. This Kevin Warsh, now he's got a lot of Fed governors who are not in line with it, but he's more classical economics. His policies, even though the administration wants the dollar to stay soft, because you can export more. It's good for American corporations to have a soft dollar. Mm-hmm. But sound economic policy leads to a sound dollar and a stronger dollar. And sure enough, we've seen the dollar go up this year. And that's also going to affect foreign stocks, because almost in 2025, almost the entire performance of the MSCI EFA index was dollar weakness. I mean, you can put it down. It's literally percent to the percent. It's almost like their economies did nothing. It was all dollar weakness. We're seeing a softer EFA this year, considerably softer EFA.
Still solid, but not as much. Yeah. And they are showing decent earnings growth, and
they're starting to look. But you got Germany and recession, England virtually in recession. I mean, there's a lot of problems in the continent there.
Germany, technically, I think finally last quarter they were slightly positive on GDP, but they were in technically a depression. They had about like 8 or so quarters of negative GDP, so that would have constituted a depression for them. So that's not great. But there are definitely a few companies out there like ASML, or if you go over to Asia and whatnot, there are a few companies that are propelling them forward, and they have those earnings growth, like Taiwan Semiconductors, that's in Taiwan.
Or SK Hynix in South Korea, and the South Korean market's done well because, of course, they've been imploding the last few days. You have to be very selective in foreign.
Just rounding some things out here. Anything else on Kevin Warsh? I mean, since he came in, and it seems like he's definitely trying to prove his independence and credibility and whatnot. He's keeping things more hands off on terms of speaking about what they're going to be doing, just so he wants to let the markets kind of do its own thing.
I hope he's successful. Once again, he's more classical economics, more supply side, and all 18 governors, I think, pretty much are going to be more or less, maybe 3 exceptions, are going to be Keynesian.
Stephen Myron is what he always wants.
So he's going to have a hard time herding those cats. It's to
say the least.
Yeah, to say the least. And but when Paul Volcker in the 80s got with Reagan and the supply side, and although he was Keynesian, he said, well, this is what the administration wants, and it worked out extremely well for us. And then you had Alan Greenspan, and he had like a lukewarm continuation of that, and it worked out reasonably well for us. We had low inflation, low interest rates, not low interest, but solid good. You get a 6% on a CD for like 25 years or something. I mean, it was.
That's nice.
Yeah,
that's good.
But mortgage rates were fine. In the 6%. I mean, it was all very reasonable for years and years. So, I think I don't know how long it's going to take him to if he can get these folks on board. It was so different back in the 80s and the 90s. But we'll see.
So that is one thing, that this inflation that we're seeing, all those scares, it's all transitory. It's going to be passing through just because it's just from the prices of oil. And if oil stays elevated, then it'll stay for longer. But as we saw in the most recent reading, for June, I mean, it dropped the most month over month since 2022 when inflation hit 9%, and that's what it was reported as.
And once again, inflation. Gold's gone down. I mean, gold doesn't care about inflation like it did. Yeah, but it is temporary. It's surrounding the Iran war. Who knows what's going to happen there? I think Iran is just playing for time, and
that's what it. Yeah,
and they want to bring us into the elections, and they think if they can change the government, they can.
They'll be happy.
They'll get us out of there, and they'll go back to doing what they do. And maybe that'll happen. I don't know. We'll see.
Any other comments, questions, or comments and concerns about just third quarter coming into it?
Well, I think the Fed governors are not going to be as conducive towards lowering rates, but unemployment numbers are great, and their mandates are inflation and unemployment. And inflation, they know, is going to go away with oil. So it would be nice if they would cut rates, because it's the interest we have to pay on our debt,
which we are reaching almost 40
trillion. Yeah, and it would be really, really nice if they would cut rates, because we have a great economy. We got the best in the world. We could have lower rates. It's almost like a punishment or something. I don't know. We'd be paying less interest on our debt. It would be smart to do. And it would be good for the consumer too. Make young people there easier to buy a house. I mean,
that's very much needed.
But it's that Keynesian mentality that, anyway.
So, I guess we'll see. With earnings still seems to be very resilient, still going through the third quarter so far. And, and
remember that when you're watching your Micron or your SanDisk, you're saying, oh, my God, that's, well, think about first what you paid for it, which is, probably very cheap. But it's come back a lot. But still, Micron is trading at such an infinitely small PE multiple relative to their growth potential, relative to the S&P, relative to just about anything. The stock's cheap. It's what, $807 a share, and it's cheap. It was cheap at $1,600 though. Unfortunately, it got cheaper.
Yeah. So I guess we'll see what happens third quarter. And we'll be back. So that rounds up things today for our segment. Now getting into John's pick of the week, farming. Something I've grown up doing, something that we have out about 15 minutes away from here. I think it's just a great thing to have done growing up, and that's the reason why I wanted to put it in this week. It taught me the ideal of hard work, a long, hard day's work, just doing it out, and also just the sense of accomplishment of doing it. And I know you've been doing it.
Yeah, we raised beef cattle. At one time, we had 100 cow-calf pairs. I mean, we were in the Angus business, and you got to do something, and it was just, I'm not a big golfer. I was when I was young, but so John grew up, and so if he worked with me all the time, but if he messed up or did something wrong, he really got to work. And I think that was a good lesson. You work harder and dirtier when if things don't go well. So you want to avoid that whenever possible.
Especially, I would never want to clean out another chicken coop again. But that, when time comes, you got to do it. But that's
or clean up fence line. This filled with briars and poison ivy and stuff. Yeah, it was a lot of.
There's definitely more fun parts and less fun parts to farming.
Or fence with, there's an ice storm, and get out there with the chainsaw and cut trees and on the fence and stretch fence and everything. So your cows don't get out, which they always do. So, but now we do corn and soybeans, and this year, in spite of the drought, it's looking really good.
Yeah.
And you sprayed, you planted, and you'll probably run the combine here in about
a couple months,
70 days or so. Yeah.
It's coming.
Yeah, it's coming.
Yeah, it's wonderful. Well, thank you as always for joining.
Good to be here.
We will see y'all here in a few weeks. Thank you for listening in. And as always buy quality and diversify. The information provided in this podcast is for educational and informational purposes only and does not constitute investment advice, a recommendation to buy or sell securities, or an offer or solicitation of advisory services. It does not take into account your individual financial situation, objectives, or needs. Investments involves risks, including the potential loss of principal, and past performance is no guarantee of future results. Woodard & Company Asset Management Group is a registered investment advisor with the SEC. Please consult your financial advisor or tax